What investors should look at before investing in mutual fund?
When you're looking out to invest into a mutual fund, it is very important that we look at 4 different aspects. The first is to know the fund house. It is very important that we know the philosophy of the fund house, we know and we understand how the money is managed by the fund house and how many schemes does the fund house have. Fund house gives a lot of information. Fund house also gives information about who are the people behind the fund house, whom are you trusting. Because when you invest into any mutual fund, you typically issue a check and rely on them to invest on your behalf, to give returns over a long period of time. So it's very important that you read all the information about the fund house. You can get the information about the fund house from Kim, from Sid, and the website of the mutual fund. Second important point is linking your objectives with the scheme objectives. This is very important. It has to match. The objective of the scheme and your end objective need to match. Because in case there is a mismatch, I may end up either risking my fund or I may end up having a smaller corpus than what I've expected. For example, I want to invest in a mutual fund through SIP over a long term for 20 years for my retirement. And I know a fund house in which I can invest. Now, there are multiple schemes. There are aggressive schemes, there are growth schemes, and there are defensive schemes. In case I invest into a defensive scheme for 20 years, there will be a difference if I would have invested into a growth scheme. In such a scenario, a growth scheme is a better option because it may give me higher corpus, which I will certainly need during my retirement. So this is a very important part. Read the objective of the scheme and understand your own objective, and both need to be matched. The information about scheme objectives can be obtained again from Kim and his scheme information document. The third important point is the fund performance. The performance of the fund, when people look at, we have different measures. People look at 1 year, people look at 3 years. We believe that the performance needs to be looked across different cycles. A scheme with a long-term performance will give much more better idea rather than a scheme with a 1 year performance or a 2 year performance. So it's very important. The track record is very important. Because the track records tell us that how the fund has done when the times were good and when the times were bad. Because the true test of the fund comes when the fund or when the markets are not in your favor. Fund information, performance, portfolio, all these informations could be obtained from fact sheet and third-party websites which give information about the performance over cycles and over a period of time. Fourth and very important part is the expenses. And by expenses we mean recurring expenses. In mutual fund terminology, we normally use this word expense ratios. Expense ratios are deducted from your overall returns, and a small difference of 0.5% or 1% could result in lakhs over a period of time. So expense ratios, a fund with a lower expense ratio, with a consistent performance, coming from a good fund house with correct philosophy over a long period of time, will be a better place to invest rather than looking at any option which are where shortcuts are being used.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.